you're used to just buying property and letting it out on a single tenancy, that's no longer a viable strategy. So it's like you say, how do you be creative? Is it serviced accommodation? Is it holiday lets? Is it multi-lets? House to HMO, house to flats? If you are investing in property this year, you have to be bold and you have to be creative.
Welcome back to another episode of the Momentum Invest Accelerated Growth Podcast. I'm here today with my host, Will Roberts, and we've been joined by Josh Knight from Octane Capital. So, Josh, thank you very much for joining us today.
No worries.
Welcome to our office in Bath.
Thank you very much for having me.
Okay, cool. Josh, we've been working together for a while now at Ramsey & White and with Octane. Do you want to let people know who you are and who Octane Capital are and what you guys do?
Yeah, sure. So, like you say, my name is Josh. I'm Octane Capital Sales and Marketing Director. Been with the business for 6 years now. If anyone watching or listening that doesn't know who we are, we're a specialist lender. We offer short-term finance to property investors, probably best known as a refurbishment finance lender, so helping investors to increase a property's value or increase its income potential. We turned 7 years old just a couple of weeks ago, so we're quite a young business.
Congratulations.
Thank you. Still here. And actually growing pretty quickly, so we're really proud. We've lent £1.5 billion in our first 7 years, which is quite a feat. So we're growing and lending at scale. Not here to make up the numbers.
yeah, of course.
So you launched back in 2017. Obviously, you've lent out 1.5 billion.
Yeah.
What changes have you seen since 2017 to now in terms of what borrowers are purchasing?
It's a really good question. I think what we've seen explode certainly in the last year is HMO conversions.
Yeah.
So 30% of our lending last year, for example, were funding house to HMO conversions. And I think the driving factors behind that are pretty clear. If you're a landlord that has been used to buying properties, letting them on single tenancies, enjoying some income from those properties, and that's been your strategy, that's not a viable strategy anymore if you need to borrow to achieve it, because the yields just aren't there anymore.
Yeah.
So more and more landlords are turning towards multi-lets as a way of improving their yields, making their portfolios more viable. And in order to convert a property from a house into an HMO, if you need funding, that's when you need a lender like us, and we're well suited to help.
Yeah. What does your loan book look at the moment? So sort of what value is it and what type of properties are you currently lending on?
So our loan book sits at around £500 million at the moment.
Okay.
So yeah, the nature of short-term finance is that you're often repaid in 9 or 10 months.
Yeah.
So the loan book increases very gradually. So it's nowhere near that £1.5 billion figure that we mentioned before. Octane are principally interested in residential and semi-commercial property. We're a non-regulated lender, so we don't lend on people's main residences. So we're only interested in investment property. We can also look at commercial, but only really if it's being converted into residential. So the loan book is, like I say, 99% resi or semi-commercial.
Awesome.
Did you see, like you mentioned then about the changes in the portfolio? Did you see off like the back of COVID, a lot of investors changing strategies? Like we noticed at the brokerage that holiday lets suddenly become a bit more appealing because of the whole staycation, and lenders kind of followed suit with that.
Yeah.
And obviously you mentioned then like multi-unit versus HMO maybe.
I think it's a really interesting time to be a specialist lender. It's actually quite a good time to be a specialist lender because it's almost like the hand of landlords has been forced. So I read some interesting stuff that Savills put out in the middle of last year that said that the average net of tax profit as a percentage of rent for a landlord has dropped to 4%, and it was 20% last year.
Yeah.
It's at its lowest point in 15 years. So, as I say, if you're used to just buying property and letting it out on a single tenancy, that's no longer a viable strategy. So it's like you say, how do you be creative? Is it serviced accommodation? Is it holiday lets? Is it multi-lets? House to HMO, house to flats? If you are investing in property this year, you have to be bold and you have to be creative. And as I say, we're well positioned to help.
Yeah.
You mentioned an increase in borrowers looking to buy houses and convert them into HMOs. So why are you seeing that trend at the moment?
Well, I mean, income you know, so we're seeing, Will, you and I came from an event in Bristol just this morning. Bristol's a really interesting area because about a third of the city has no Article 4 direction.
Yeah.
And for anyone that doesn't know what that means, it just means that you can convert a house into an HMO of up to 6 bedrooms with no need for planning permission. It can all be done under permitted development. You don't even need to inform the local authority of your intention. You still need a license, but you don't need planning. And that gives a landlord the ability to turn a pretty boring property from an income perspective into something that can generate a substantial yield. The example that we were talking about off air, Will, we had a client that converted a 3-bed house in Bristol into a 6-bed HMO under PD. Had he let that on a single tenancy, it would have been generating 15, 16 grand a year. He's now fully let it to students for £58,000 a year. So you're talking of, you know, my math is awful, but somewhere between a 3 and a 4 times increase in the property's income potential with no planning permission.
Yeah.
It's kind of like, you know, no brainer. Yeah, it's you hate that phrase, but it is.
And also it's rinse and repeat model, right? So not to be overexposed, but having 1 or 2 or 3 in the portfolio can certainly help, especially if you've gone from, you know, lower yield to that higher yield, as you're saying, or return on investment.
You're 100% right. And what we're seeing is once a landlord gets one under their belt, they become addicted to it. And to use your phrase, rinse and repeat, you increase the property's value, you increase its yield, you then buy to let, refinance onto a longer term mortgage to repay your bridge. But normally the value of the property is increased enough and the yield is high enough, or the yield is improved enough for you to borrow at a high loan to value on the exit, pull out some cash and then just do it again. Yeah. And then suddenly your deposits become
it's not that like traditional way where you're buying a house for 100,000, you've saved 25,000 on, inherited the money, and you put 75,000 down from a lender and 25 yourself, and you save another 25, and then it's actually you use that money to buy an asset, add value with one of these strategies, or you've bought below market value with a lender like yourselves, and then add the value and then recycle the capital on the refinance on the way out, where you're paying off your loan and maybe some surplus, which is your deposit and funds stored to work. So it almost increases your, not almost, it does increase your return on capital put into the deal, right? Yeah. So I guess that's where the addiction comes in, because you're like, actually this money's really working hard for me.
Absolutely. And the non-Article 4 piece, I think, just means that the barriers to entry are so low. You're not buying a property waiting 6 months for a local authority to give you planning. It falls under PD, so you can buy the property and start converting it immediately. So my example that I gave of that almost 4 times increase, the borrower completed the works in 5 months and then he exited it within another month. So from buying the property to exiting the bridging loan and onto a buy-to-let mortgage was 6-7 months.
Good turnaround.
And then he can do another one. So you're talking 2 or 3 a year. Yeah. So the scope for landlords to build substantial wealth using bridging finance, that's a real opportunity, and it's something that we're seeing people use.
What do you think? Because like, I want to talk about valuations in a second, but just because you mentioned bridging, a lot of investors or people that want to become investors, suddenly like they're interested in creating wealth, so they look at properties as an asset class. You know, the pensions haven't performed that well, or other investments. So okay, I'm going to get into property, and they start speaking to specialist advisors, lenders like yourself, and it's like, okay, well, you need a bridging product if you're going to be doing any conversion work or changing use or whatever. And they naturally then go, oh, bridging, I've heard bad things. But it normally comes from like, you know, someone when they wanted to buy their dream home but hadn't sold their other home. So they've had to bridge the gap. And then there was maybe some sharks in that space back in the day. Like, what's your view on the bridging market? And what would you say to people that kind of have that nervousness about bridging?
Sure. So look, you're right, and borrowers would be right to recognise the history of bridging. In that, I think when bridging first emerged as a tool for borrowers, it was an unregulated market. It was, as you say, it was probably lender of last resort. I'm in a bit of a hole. I need a lender to bail me out. Yeah. And maybe the practices of treating customers fairly and those frameworks didn't apply when bridging first emerged, and we're talking maybe in 2005, 2006 onwards. Whereas now bridging is a sophisticated market.
Yeah.
You have reputable lenders like Octane in the space. You've got banks, regulated entities that provide bridging loans. So most of our competitors are banks themselves in their own right, so clearly regulated. And I suppose there's different ends to the market. You know, we operate in a space where we want to align ourselves with ambitious property investors. So we don't necessarily lend to borrowers that are, you know, have terrible credit or that there's risk of them not being able to repay the loan. There are lenders in the market that target those types of
market
customers.
for that.
We target ambitious investors that want to build value and build wealth. Sophisticated investors.
Yeah. They're professional, right?
Yeah, totally.
Yeah. I think that's where the market's really shifted. It's like as a business, why would you not want to deal with clients who repeat clients, but also will repay the product or the loan you're offering and build a successful business alongside what you're trying to create. So as their business builds, so does yours.
Sure.
So it's kind of a symbiotic relationship, isn't it? So it's a win-win. And I think that's where we've seen the bridging market really change when they've gone, oh, hang about. There's a group of people over here that kind of need this product. We can service that and actually build a good relationship with them. So then professional investors, developers can really benefit from doing things properly with bridging lenders like yourself.
Yeah.
That's what I've found anyway.
And I think, look, it's an essential tool.
Yeah.
You know, let's say you've got a 30% deposit and you're buying a house and you want to convert it into an HMO, you know, and you need funding for that project. Where do you go?
Yeah.
Do you go to a buy-to-let lender?
Yeah.
You know, who's going to lend you cash when you're making substantial, in some cases, structural changes to the use of a property? You know, you need to work with a specialist lender that has a product that's designed to help you achieve that goal. And that's where we step in.
Yeah.
You know, that's the type of project we lend on.
What I love about Octane is you understand the strategies that you know, these people are trying to implement and how to fund that. And I think that's the key difference, you know, how you can, that value that you want to add into the portfolio, we get it, but also you will stress test if it actually stacks up. And I think sometimes when we speak to investors, they're like, oh, you know, they want to do this valuation and that, but I'm like, you should welcome it because they want to lend, trust me, but they're just checking if the project's viable or not. And actually, if it comes back and it's, well, this is not quite right, you can then go back to the vendor or you can recheck the project or you can push back and say, well, actually, I think it is viable because of this, and this. Yeah,
and coming back to your point, you know, about reputable lenders in the space, you know, we have a duty of care to not let a client enter into a project that we don't think is viable. So for a great example of that is that if somebody's buying a property, increasing its value with the view to selling it, we would expect them to make a 10% profit.
Yeah.
If post-valuation it comes to light that that profit margin's not there, we often wouldn't proceed with the deal.
Yeah.
Because we don't want them to, because you know as well as we do that build costs can sometimes escalate.
Oh yeah, of course, especially over
And
the
then
last couple of years.
Exactly right. And then you get into a situation where a client's in a difficult situation, and we are not interested in lending to people that struggle to repay our loans.
Yeah.
Our default rate is minuscule.
Yeah.
Because we lend to the right people at the right loan to values, and we assess their projects, as you say, in the right way.
How do you get that balance of assessing the quality of the deal and the borrower and the speed you offer? Because I find, like, just genuinely, you are one of the quickest lenders and especially business development kind of managers in that space. If I send you something, you're like, Joel, this is my thoughts on it. And I'm like, wow. Like, we all say it around and like, Josh is quick. But you also have a keen eye for if a deal stacks up or not. So what is it about Octane yourself that kind of, is that just a culture, experience, quality? Like,
I think the speed thing is probably just an obsessive part of my personal character, because like I'm always acutely aware that when you send me a deal, you probably sent it to a few other lenders as well. So I want my terms to be first in your inbox. Yeah. In answer to your question about assessing risk, I always remember when I first joined Octane, our director of credit, his analogy that he uses is like, imagine you've got 3 different levers, one for the asset that you're lending on, one for the borrower that you're lending to, and each of those and one for the exit, the way that the loan's going to be repaid. Yeah. And each of those is its own barometer of risk. So you might have, for example, an asset that you really want to lend on, but perhaps the borrower's not as experienced as you'd like them to be. And it's just about balancing risk, you know, and a lender's, the best way that a lender can adjust their exposure to a deal is just adjusting the loan to value.
Yeah.
So you might say, we're willing to lend in this scenario, but not at a high loan to value. So if, for example, you've got a client that's borrowing for the first time and it's their first project, okay, maybe we'll look at it, but are we going to lend to them at our maximum loan to value where we know that problems might arise and it might put them in a difficult position? No, we'll lend to you, but at a conservative loan to value, because we don't want to put you in a position where you're overexposed.
Yeah, makes sense.
You mentioned development exits. For those who don't know, what is it and how can it help them?
Yeah, so a developer exit loan is just a bridging loan, but it's just used to help repay development finance on a site. So let's say you're a property developer, you've built 10 houses using development finance. It's taken you longer than you had anticipated, which is often the case. Maybe it's cost you more than you thought it would because build costs have risen. Or maybe it's just the case that they're not selling as quickly as you thought they would. Because as we know, property sales have slowed substantially over the last couple of years. What we find is that some of those developers just need more time, either to sell their units or in many cases to finish off the development. And they've got their development lender breathing down their neck wanting to be repaid. So a bridging loan repays the development lender and it just buys the developer a bit more time to finish, market and sell those units without pressure. And alongside HMO conversions, that's probably the second biggest area we've seen over the last year or two.
Yeah, because HMOs can be quite tricky to sell. So the clients, their exit is sale. Does it worry you at all that they won't be able to sell in the time they've mentioned?
Well, if you're doing a house to HMO conversion, your exit is almost never sale. Because
Only if you're forced to.
yeah.
Well, you typically want to refinance it and keep it.
keep
What's
it
the point
for
of developing it out? You know?
Yeah, so the developer exits that we do are for developers that have built properties with the view to selling them to owner occupiers usually. So a dev exit loan would very rarely be used on an HMO.
I think where we've done it with Octane in the past is like you said, they've got several houses, they're selling 1, 2, 3. They've got another site that they're looking to buy, and they use the equity that they've created in the site to effectively look at that other deal or take advantage of the opportunity while other sales are going through. So it's a great product to use, especially for like a professional developer who's got multiple schemes on the go or building out their pipeline, I guess.
Yeah, I mean, cash flow we've learned is key for developers. So one thing we do, let's say we're lending on a development of 10 houses, as the developer sells off those remaining units, we often allow them to keep a proportion of each sale as those sales go through.
Yeah.
So just releasing their profit from the deal early that they can funnel into other sites, like you say.
Yeah, no, it's really good. One thing I want to talk about, Josh, is the piece about the refurbishment part, because I think a lot of borrowers don't understand that they can actually borrow money towards the purchase, which is like typically deducted, so they put their deposit in minus the additional fees. Then they can get the money for the refurb, and that's typically 100% funded in arrears. Can you talk to us a bit about that, how it works for someone who wants to do kind of a refurb or conversion, but is struggling maybe to understand that part?
Sure. So let's just say you're buying a house for £500,000 and your plan is to do a loft conversion and extend to the rear of the property. And let's say that those build costs are going to be £100,000. When we offer a refurbishment loan, there are two parts to the loan. The day one loan, which is the amount that we lend the day the loan completes, and that's 70% loan to value net of interest. That net of interest point's really important. We don't deduct any interest from the day one lend. Interest is added to the loan.
Just on that point, do you have an average of actually what that LTV looks like across the book? So, because when I say to a client, you get a 70% day one, they think in their head 30%, but obviously, like you said, it's net of interest.
No, sorry, but we don't deduct interest.
So you roll it.
Yeah, so this is the key. So what most bridging lenders will do is they'll say, we'll lend you 70, 75%, but 12 months of interest is deducted.
Yeah.
So you're right. The average that they actually take home is
Might be like
sometimes 60.
Yeah, exactly. Yeah.
We don't work in that way. For
Yeah.
a refurbishment loan
Yeah.
where you're adding value,
Mm.
we lend 70% net of interest.
Perfect.
So that means that you get 70%
Yeah.
towards the purchase.
Yeah.
The only thing to come off that is the arrangement fee.
Yeah.
So in answer to your question, it works out at 67.5%
Yeah.
net.
Got yeah.
So you put in the remaining just over 30%
Mhm.
deposit day one. So that's our day one loan, 70% loan to value. As you say, we then fund 100% of the cost of the works. So in my example of £100,000 worth of refurbishment works, 100% of that is funded. It's drawn in arrears, and what that means is that the investor would spend the first, let's say, 30 grand of their own money, and then they would make a draw from the refurbishment facility to reimburse themselves,
Mhm.
and then that process repeats
Yeah.
until the project is fully finished. But then in my example of somebody improving a property's value through increasing its floor space, the idea there would be that they would then go on and either sell it for a profit,
Yeah.
or they would refinance it with a term lender. But the point is that they've engineered value.
Yeah. And a good thing is, like, say there's a 25% profit margin
Yeah,
for effectively putting in, you put the 35% deposit down, your legal
Yeah.
fees, the soft cost. Yes, you're borrowing the debt, but you rather than putting 100% of that money and you put in a percentage in, which still gives you the 25% profit. So it's like, why
Yeah.
wouldn't you use it?
yeah. And
Yeah.
the other thing is that a common misconception is, people say, oh, bridging finance is expensive, and how am I going to afford my monthly payments? So the way that we work is that we roll up interest within the facility. So there's no monthly payment. There's no cash flow burden. When you repay the loan, you repay the loan inclusive of interest.
Yeah.
And you're only repaying the loan when you've realised your profit.
Yeah.
So yes, you repay the loan plus interest, but if you've got your numbers right, and we'd only lend to you if you have, you're enjoying that uplift in value when you come to sell the property. And we see people achieve 20-25% profit on cost.
Yeah.
That's not unattainable, especially if you're adding significant floor space.
Yeah. I think as well that we're seeing now is a lot more opportunities in the market. Because if we got an estate agency business and we launched it during COVID, they've sold like and it was like, this was madness operationally, but also trying to find deals then, because everyone's expectations of value of their property has gone through the roof because there's so much demand. So as an investor at that point, there were still deals to be done, but they had to look a lot harder.
Agreed.
Now it's the other way, where like, okay, interest rates have gone up. There is an element of some vendors believe that their value is still what it was, but the ones that come a bit more realistic, there's still very strong motivations in the market. They never go away. Relocation, upsizing, downsizing, divorce, bereavement, whatever that may be. There's still deals to be done, but there's less competition from what we're seeing. So like where it was 130 viewings or inquiries, it's now like 35, 40. So the houses are still getting sold, but there's less competition. So for investors who kind of, okay, everyone's kind of moving away, now could be a great time to get an opportunity, especially if you guys are still lending and putting deals together.
Yeah, because a bridging loan almost puts you in the position of being a cash buyer. So we all know that being a cash buyer carries weight with vendors, especially ones that are under pressure to sell. I read recently, and don't quote me on the accuracy of this, but the average time it took for a vendor to achieve an exchange last year was 139 days.
Wow.
So that's
It's probably because every agent was like, I can sell your house for a lot more. It's like, oh, wait, hold the sale.
it's your fault.
yeah.
But that's a substantial amount of time. So look, if you have bridging in your corner and you're able to, we complete deals in 2 or 3 weeks.
Yeah.
And then you open the door to, can I get this below market value because I'm able to complete quickly? And then your deposit becomes even less.
Yeah.
Some lenders lend against value rather than purchase price. So there's, like you say, it's a buyer's market. But for us, it's about partnering, as I said before, with ambitious investors. You've got to be bold enough to go and seize opportunity.
Yeah.
Yeah, it's definitely a buyer's market.
I think having the right team in place can help you take advantage of them opportunities as well. You know, I think some people feel like they've got to do everything themselves, but actually you don't know what you don't know. So lean into your lenders, your solicitors, your advisors, and, you know, do your own due diligence, of course, but actually, you know, like Ramsey and White did circa 700 deals last year, about 110 in completed loans, 110 million in completed loans,
Wow.
right? So, like, speaking to Paul or Dean or myself or Will, we've seen hundreds of deals. So it's like, okay, we've seen this done before. That doesn't work, or actually you can do that and structure it like this and partner with someone like yourself at Octane, Josh. It's like you've then done, like you said, 1.5 billion in lending. So combine all that together, it kind of, as you were saying earlier, de-risks the deal. You're like looking for that risk mitigation to make the deal work. So if you've got the ambition, like you said, that will take you so far, and then you leverage the experience of the team, make the deals happen.
Sure. And I think there's also a misconception that, you know, lenders like us, we only lend to really experienced property developers. Like, a lot of our clients are just landlords, you know, frustrated landlords that have turned to HMOs. And look, we're under no illusions that most of the borrowers that we lend to, they're not full-time property professionals. Most of them have a full-time occupation, and property is a side hustle for them. So we're not expecting those borrowers to go out to site, roll their sleeves up, put a hard hat on, and actually start knocking down
You would
walls.
want that, wouldn't you?
So, you know, a lot of the time, 99 times out of 100, it's a contractor that's gone in to do the works from start to finish. So as long as we as the lender can ascertain that the contractor that's actually doing the work is reputable, ideally on a fixed price contract, then we're really willing to lend to people doing their first project or their second project. And you don't have to have this long decorated CV of successful developments that you've done. And that was kind of one of the points that I was making about the barriers to entry being so low. The finance is there, you know, we're willing to lend. There are opportunities like the non-Article 4 6-bed HMO conversions that we mentioned. You know, the opportunities out there for those willing to go for it.
So a lot of people probably wondering, over the next 12 months, let's say they have a few £100,000 available, what opportunity is there in the market? You know, do you think it'll be more HMOs, more unit blocks, developments, or do you reckon the standard buy-to-let's coming back over the next sort of 1 to 2 years?
Well, I think the standard buy-to-lets being viable will only come back if we see a substantial drop-off in rates. And I don't think anyone's expecting that to happen significantly anytime soon.
No.
So I think it will still be these creative strategies. So yeah, we're anticipating another big year for HMOs. Another opportunity that we're seeing people explore is vacant commercial into residential.
Okay.
So if you've got certain vacant commercial properties can be converted into residential dwellings under permitted development, you still need to seek approval from the local planning authority. It's called prior approval, but it's not like a full planning permission application that can take 4, 5, 6 months. We're talking it can take 6 weeks or less in many cases. And that's just a reflection of the fact that local authorities are desperate to get vacant commercial buildings off high streets or out of their localities. But also every council is under pressure from a housing perspective. So if you have a developer willing to take a vacant commercial property off the streets to solve that problem and create some housing at the same time, you can see that there's a real willingness there to cooperate. And what's really interesting about that is that, let's say you've got a client that's buying a vacant commercial property with the view to converting it into residential. If they can agree with the vendor of the property that they can submit their prior approval application at the point that the offer is accepted, and they only complete on the purchase once it's been granted, that's really interesting, because what they'll have done there is increase the property's value before they've actually bought it. And then a lender like us, we would lend against value, not purchase price. So that means that they might, rather than a 30% deposit, they might only have to put in 15%, and then we fund 100% of the conversion costs.
Nice.
And many vendors of vacant commercial buildings would be amenable to that, because that process is quick. It's usually a few weeks.
We'd taken a large office just outside Cardiff, and through the viewing process, we found that there was a lot of commercials, properties that were vacant, and the vendors were struggling to
Yeah.
let them, just because of what happened with COVID and people working from home or businesses being a bit more flexible in that sort of sense. So it was great for us to negotiate on price and stuff. But it just shows me that there's opportunity to kind of take advantage of what you're talking about. So it's definitely worth reaching out to kind of the commercial agents and seeing what's not sticking at the moment, and see if there is an opportunity if you're willing to take that next step into, or you're already in that space, I guess.
For sure. And the real gold mine is, like I say, if you can make your purchase conditional on the residential conversion being granted, then that's a real way of reducing your capital input.
Yeah. And what are you like? Is there like a sweet spot for Octane in terms of commercial to residential, like 5 units, 10, 20, 50?
Well, look, I mean, we only have, like I said at the start, we're only really interested in commercial if it's being converted into residential.
Yeah.
So as a lender, we wouldn't lend on a commercial. We would rarely lend on a commercial building unless it had consent to be converted into residential.
Yeah.
In terms of number of
So
units,
they negotiate that, is what you're saying. They get that in place. Then they come to you and say, look, we've secured this, and then this will be the uplift in value. This is the work
we
cost.
advise them to do that.
Yeah.
You know, quite often we get a case where somebody says, I want to go and buy this commercial building, and once I've bought it, I'll submit a prior approval application.
Yeah, you're saving on bridging costs, right? If you do it the other way, like you're saying.
Exactly.
Yeah.
If you avoid the need to do a bridge first, then great. So when presented with that kind of scenario, we often say, look, get your prior approval application in now, because if it drops, if it's granted before you complete, then that can be really beneficial for you.
Can they submit the prior approval before owning it as well? So
with the vendor's permission.
With the vendor's permission.
Yeah. And then just explaining to the vendor that it's often a quick process, making it conditional. Obviously, you've got to make the offer first on the assumption that planning hasn't been granted in order to engineer the value.
Yeah.
But in answer to your question, like, there's no real sweet spot for us. The complexity of a project, as that increases, the level of experience we'd expect the borrower to have also naturally increases.
Yeah.
So if you're buying a 6-story office building and converting it into 15 flats, that's a substantial level of works, and we'd expect you to have the level of experience that would be required. If you're doing a house to an HMO conversion, it's not necessarily a complicated project. First time developers, that would be fine.
You mentioned, Josh, that you've completed deals in 2 to 3 weeks.
Yeah.
What does a borrower need to prepare for to ensure that they can get speed of kind of transaction and move forward in that? Like, I've got my views on it, but from a lender's point of view, what does that borrower need to have in place to?
Yes, I would say the most important thing is pick a solicitor that is used to operating within bridging timescales.
So important.
So, there is not all solicitors are equal. So there are residential conveyancers that are used to dealing with Mr. and Mrs. Miggins buying a house, and those processes take months. What you need is, and to take advice from your broker, a solicitor that is used to operating very, very quickly. So that's the key thing. If you want a case to complete very quickly, you've got to kind of throw your money behind it. So, if we're taking on an auction deal where we've got to complete within 28 days, for example, we would expect the borrower to pay for their valuation that we instruct and pay their legal fees day one or, day two. And then both of that valuation and legal process runs concurrently. If you're waiting until the valuation comes back before you instruct your solicitors, you're just pushing the process further down the line.
Yeah.
For us to achieve a 2-week time frame, you've got to get those processes started day one.
I think it's like for a borrower, for how you can help or how you help yourself is, say you're looking at an auction purchase, that you've done your due diligence on that project. You spoke to your solicitor that, look, I'm going into auction next week, I'm going to bid. You spoke to your lender, your advisor. Look, how would I fund this deal? I've got this amount of money. Okay, how much do you want to buy it for? How much work you can spend on it? What are you going to do to it? What's the uplift in value and what's the exit? You'll have all that information going into the auction. So and everyone else knows, once that price goes down, or that hammer goes down and you've secured it, and everyone just takes action.
Yeah.
We had one of the advisors, my younger brother actually, Jordan, when he worked for us as an advisor, one of his first deals was an online auction, and he was sitting there watching like, come on, because he'd been working on it for the last 3 weeks, with the client going back and forth with one of the funders who operate in that space. So the solicitor was teed up, he was teed up, and then he was so excited when they won, and then it all kicked into place and it went through in a time frame. So it's just preparation is key, I think.
100%. And look, there are so many tools at your disposal that are free. Like, you know, every day we get presented with a case where a borrower says, my GDV, my end value post refurb is £1 million.
Yeah.
You know, and they see these big numbers and they think they're achievable. When a valuer goes to value the site, they are only assessing the numbers based on sold comparable evidence.
Yeah.
So unless properties of a similar spec in a similar location are transacting at £1 million plus, that isn't an achievable number. And all of that data is available on Rightmove. You go on Rightmove, you go on the sold house prices, look for a similar floor space, look for a similar locality. What are properties transacting at?
Yeah.
Because that's the data that a surveyor is going to use.
Yeah.
And that's part of our job, again, to come back to treating customers fairly and doing the right thing, is that even before getting a client to pay for a valuation, if we think the numbers are way off, we tell them, this is not a good deal for you.
Yeah.
You know, your numbers aren't right here. You're going to pay for a valuation, it's going to die. We're not going to fund the deal because the numbers don't make sense.
There's a lot of stress, and you blame the lender, blame the brokerage, you want to work with them. Yeah. What would you say to borrowers who want to get a valuation done before doing the deal, like almost? And because I've had it in the past where, you know, they kind of got some property, they're doing a larger deal, and for some reason they paid for a valuation independently, and that valuer has given them exactly the figure they want. Yeah. Then we've gone to a lender, and it's a third party valuer goes out and it's completely different. Yeah. And they're like, well, I've got this valuation, and it's like, that's fine, but they typically have asked you what you want, and then you've told them, and then they've told you what you want, and then this value is just never, not always has worked in my case. Like what, and then they pay twice as well. Yeah.
So what I would say is, and this does happen quite a lot, is if you've got terms from a lender, but you're not willing to go to full valuation because it's expensive, ask the well, this is something certainly, I don't know whether other lenders do this, but we do. We would be willing to instruct our valuer to do a desktop valuation. Yeah. Normally for a couple of £100, £300-400 maybe. Just to kind of give you a sense check of the numbers. They can't be relied on, but they definitely will give you the region that the numbers will end up in. Yeah. If that's palatable or the numbers are workable, we then instruct that same surveyor to then go out and validate their original desktop research. Yeah. And then it's just a way of not committing to...
It's like a stepping stone.
Yeah, exactly. And do the numbers make sense for me? And I think you're right. There are... especially first-time developers who are always very tentative. You know, you don't want to get pregnant with a project that's not going to make you money. Yeah. So I think that desktop valuation as a first step before you do anything makes total sense. Yeah.
Yeah, we're not endorsing getting pregnant for money either, by the way. So, what I'd say on the, just if you're looking at HMOs, a good one I would say is speak to the local commercial surveyors in the area. Like, you don't have to instruct them to do any valuations, but say, look, I'm looking to take on a project. I want to convert a house to HMO. Need to get funding. Want to build up my network of valuers and lenders, etc. What are you valuing properties for in this area for? And you know, some will be a bit grumpy, won't tell you. Some will actually say, we're looking at it at this value. That's a good steer because you have on the ground market knowledge, and then obviously you still got to go through the process with the lender and their valuer, etc. But I find that on the ground works.
And ask your lender. This is the point, Will, that you and I were talking about. You know, just before we started filming, we've probably funded 50 house to HMO conversions in Bristol last year.
Yeah, exactly.
No exaggeration.
The data that you have already.
Totally.
Yeah.
So, and again, that's something that we sense check. You know, if somebody comes back to us and says, I can get a 7 or 8% yield in this area, like, you know, we've got 20 odd valuation reports in a 0.25 mile radius of that property that we can look at and go, you know, your numbers don't stack up to these numbers, or they do stack up. That looks a great deal. Let's go fund it. We funded ones just like it.
And I feel like that data is so valuable to making sure a project is viable or not. Yeah. Because why wouldn't you want access to that to not waste money but make money? 100%. Hopefully, you know.
And look, we keep circling back to it, but your lender has a duty of care to make sure that your project is viable before lending to you. And look, unfortunately, there are lenders in our space that operate in a different way, and that maybe are incentivized for your loan to go over term because they get to charge you extra fees. And sadly, there are lenders out there that operate in that way. We're just not one of them. We would rather walk away from a deal.
Too much headache.
Yeah, than rather than
Fight
let you get into a bad situation.
Yeah, I think on that one, it's before doing a deal, or you say you're starting to work for a deal with a lender and advisor, just ask what the conditions of the offer would look like. What is your standard conditions of offer? Okay, this is our rates, this is what we pay, this is the charges if you do go into default, we're going to work with you so that doesn't happen. Transparency, but you've got it all there in black and white. And then I always say, because there's no hidden costs or any, and it does say this will happen, rather than giving it to them when it does happen. So, you signed it.
Check the small print.
Check it before you get into the deal, right?
Definitely, and does the lender charge fees if loans are repaid just a few days late?
Yeah.
If you go over term, do they load your interest rate?
Yeah.
Are there exit fees? Is interest, does it accrue daily or monthly?
Yeah.
And just to put that in perspective, Octane, look, if you need an extra 3 or 4 months, we'd normally charge a small extension fee. We don't load your interest. Interest accrues daily, not monthly. We have no interest in profiting from a client's misfortune. It's just not the way that we work.
Yeah.
So, we understand that sometimes things don't go right. And if you need an extension, you can have one. But we'll try and work with you to get the loan repaid without too much undue pressure.
Yeah, my experience with when deals are overrunning, you've seen it COVID, before COVID, Brexit, different scenarios that happen in the market. And it's meant the delays happen. But the best thing that you can do is just communicate with whoever set the deal up, and the lender say, look, this is where I'm at, this is where I want it to be at, this is why the delays happen, this is what I'm doing to rectify it, can you work with me?
That's the best advance as possible.
Yeah, because that's the best thing. Okay, well, this is typically our process, but because you've told me this is what we're going to do to help you, and you'll just have a better relationship rather than burying your head in the sand and it all going to shit, excuse my language, but I've just seen that happen, and you don't want to be in that position. You want to work through it as quickly as possible. Because some funders, it's like the client said, I'm getting charged 3% a month now. Like, well, you was always charged 3%, but they just did a discount for the first 6 months. But that's in the small print, and you've got to read that sort of thing. So, it's having your eyes wide open.
And you're definitely right. It's a lender's worst nightmare for borrowers to go quiet as you approach the end of the term.
Yeah.
Like we will be much more accommodating if 6 months before the end of the term you go, do you know what? It's looking like I'm going to need some extra time to finish off this build.
Yeah.
Okay, great. Well, let's sort your extension terms now.
Yeah.
Give you an extra 3 or 6 months. As I say, we don't load rates. We charge interest daily. So if you do repay us on time, there's no cost in terms of interest. But yeah, just keep your lender informed.
Yeah.
Work with them.
Yeah.
And pick the right lender that's going to be accommodating.
Yeah, agreed. So I think in short, it's basically get your ducks in a row. What you're buying it for? What's it worth? How much you spend on the work? What you're doing to the property? What's the end value? Make sure you've got the right solicitor, right funder, your team in place, and you can add value to your portfolio by using the right products. So we've seen it happen. Octane has seen it happen. Obviously, 1.5 billion in lending. I'd love to know what the GDV value of all that.
Yeah, I have no idea.
Yeah. Because that's a lot of value in the marketplace, right? Because we say we've done 110 million in lending, but actually, what's that in property value and portfolio value and equity and children's inheritance later down the line? Look at the value.
Once you put it into perspective and you think about the number of lives changed, whether it's the people that you're lending to, or the people that are occupying the properties, it's serious.
Yeah, if you take it properly, seriously, and adding value, not rent it, forget it approach, but actually I'm bringing a product to market that adds value, so and has longevity. But yeah, okay, cool. Anything from you, Will?
Yeah, so all our clients, obviously, they look to refinance or buy property and they're getting funding, and that's all they really see. But obviously, as we know, every lender has different funding lines. Yeah. So can you talk to us a bit about how you guys structure your funding lines, where you actually get the money from?
Yeah, sure.
That'd be really interesting.
The Octane money tree.
Yeah.
So you know what? I actually
need another Billy.
Do you know what? I actually think this is one of the most important USPs for Octane.
Yeah.
Most bridging lenders have multiple funding lines and they're finite. And you'll know this from the market. Every week a bridging lender announces their new funding line that they've just attained. We are completely different in that we have one funding line They've always been our funding line, and they are an equity partner in the business. They are an asset management firm with 20 plus billion under management.
Yeah.
So they're a substantial institutional investor. So firstly, that gives us access to substantial capital. That's one of the reasons we've been able to scale so quickly. But one of the most important pieces of that is that they're an equity partner in the business. So there's no interest in them, cutting our line of funding, because they benefit from the growth in Octane. And the other benefit that gives us is that our cost of borrowing is very low. And that's why our rates, as of the time of recording, start at 0.77 a month, and the industry average is 0.95 plus.
Yeah.
The reason that rates are expensive is that the normal bridging lender has to borrow to lend.
Yeah.
And they're, and once everyone's piece of the pie stacks up, that's when you see rates escalate. And we don't have the same structure with Octane.
I think that's really interesting. They've got an invested interest in the business doing well, and it's their own effectively money lending into the business. So the margins can be better, which is great.
And you often hear this kind of like term certainty of funding. When you submit an inquiry to us, it's not like we have to ask questions as to where that money's coming from.
Yeah.
We know how our loans are going to be funded before an inquiry crosses our desk. So that means, when we say yes, we mean it. It means you can rely on us. It means that when you get to exchange point and you're committed to the deal, you know that the funds are there and that we're going to be able to fund it.
Yeah.
And I think that's really important. You've seen bridging lenders. I've only been in bridging myself for 6 years. In that short time, I've seen lenders come and go.
Yeah.
And it's funding problems that cause those issues.
Yeah, you had there was a great lender we were working with, the people that they were behind Shawbrook, and they set up, and they that's not really funding it anymore, but they were great. They knew what they were doing in terms of the knowledge. I've seen it with a number of lenders, and I think you're absolutely right that certainty, because at the end of the day, if you're an investor, a developer, that funding is a massive part of your business, unless you're using your own capital. Totally. But, so you might be raising private funding, but then there'll be the piece from the lenders like yourself. So knowing that they've got a track record and they're well funded, it should give you the certainty to do the deal.
Yeah.
So,
and that the terms aren't going to change.
Yeah.
Because the issue, if you've got multiple funding lines, you've got multiple different costs of borrowing, pots of cash that are becoming finite. When you offer terms to a client, you want them to have total confidence that when they come to complete the loan, those terms are still the terms that you're offering.
That's a key one. Yeah, because it's you're halfway down the deal, and suddenly it's oh no, now the rate's gone from 0.77 to 1.2.
Yeah.
That's right. What about last one for me is private funding. So if the borrower is got a site, they've secured it, they need some money from yourself, but then the deposit side is coming from a private investor who's not a JV partner, but private, so maybe a loan agreement type thing. How does Octane sit with that? Is that kind of comfortable? Or?
Yeah, definitely. Yeah. I mean, I don't know what the percentage is, but I would be surprised if it's less than half of the deals that we fund don't have outside investor cash in the deal.
Yeah.
The only thing that I would say is that just because you're a silent investor doesn't mean that the lender can turn a blind eye to where that money's come from.
Yeah, of course.
So even though we're not a regulated lender,
yeah,
we have a regulatory obligation to underwrite the source of all money going into the deal.
Yeah.
So if you are an investor in Joel's deal and you're putting in 100 grand, we have to know where that money's come from and you have to evidence it. So as long as your investor is willing to accommodate that request, then there's no problem. The problems arise where it goes, my mate's giving me 50 grand, but he doesn't want to tell you where it's come from.
Yeah.
So I get that's a problem.
Yeah.
You know,
and I think that's crucial. A lot of our borrowers taking advantage of opportunities in the market. They're putting in the groundwork, going and finding the deals, putting it together, getting the builders on board, creating real value, and then they come to us to find a lender.
Yeah.
To an investor, look, I haven't got the expertise or knowledge to go and find deals like that, but I am sitting on cash. And I want to get a better return than I have been getting in a bank or wherever. So they do a deal together. That's absolutely fine. I think that's a great a great place to be as a proactive developer investor.
Totally.
But we've had it in the past where that investor has borrowed money from a private investor, and then we're doing a due diligence because we do the same, like, okay, where's the funds come from? And then there's 4 other investors behind him. We're like, well, what's going on? But it turns out the 4 is all legit, and the lender's still lent, but we had to go through that process. So I think as an investor yourself, you should be doing that due diligence anyway. You should be knowing where that money's coming from.
And I think you kind of intimated a point there, which is transparency is always key. So what I always tell to my brokers when they bring me deals is there are no wrong answers here. I'm not trying to find a reason not to do this deal. So tell me everything that you know, find out everything that you know. So if it is, like you say, not one investor, it's 4, find out who those people are, what their occupations are, where their source of wealth comes from, and give that information. None of it's going to be a problem. It'll only become a problem if we get further down the line, you're pushing us to complete, and then we find it out the day before completion.
Delays.
Exactly.
But it's back to you want to lend, but you've got to mitigate the risk. You don't want to lend recklessly.
We just need to know the information. And it's just about transparency. It's the same as, if you've got a blip on your credit file, it's very unlikely to be a problem if you were late on a utility bill payment and you brought it up to date, or you had a CCJ 3 years ago and it's now been settled. That's not going to stop us lending. But it will cause a delay if you don't tell us and then we find out, and then it's do you know what I mean? Terms at outset.
I think bridging can be used in many ways. Like, for example, we've got clients who don't want to do buy-to-lets to their first property, they want to do HMO, but most HMO lenders want you to have experience as a buy-to-let landlord or a HMO landlord. So how do they get into the market? Well, one, you can't go on a buy-to-let product anyway, or a HMO product, because it's not HMO yet, so you need to convert it. So you can use a bridging loan and maybe a refurbishment loan as well to buy the asset, do the work, get it rented out, hold it for 6, 9, 12 months, and then go on to a HMO lender, because now you own an asset, you have the experience, and and that's where bridging is like really valuable. So
often people talk about bridging as being like a stepping stone, and it's a great analogy because you're right. Day one, the options for lending in terms of term finance might not be there. The bridge helps you get there. You have the required experience, and then your options open. Once you've taken that first step.
Awesome. Okay, cool.
Last question from me. So the podcast
I did say one.
One last question. So the podcast is called Momentum and Invest. So what does momentum mean to you?
Another 1.5 billion.
Well, nice.
Sorry, Josh.
Do you know what? I think that you've probably hit the nail on the head there, Joel. For us, it's about scaling. We are, because of our funding structure, we are shackle free. There are no limits to the amount that we can lend. And we have big targets this year. We had a good year last year, 110% of our target for 2023 in terms of our company lending. We've added a third on to that target for this year.
No pressure.
So we're hungry to lend. So I guess my point would be we built momentum last year, and we want to take it through this year and smash those targets.
Awesome.
Okay.
Thanks for coming on.
Thank you, Josh. Everyone at Ramsey & White appreciates working with you. Obviously, one of the best BDMs we work with. And thank you to Octane. If you have any questions about today's episode, then please reach out to Ramsey & White or Josh at Octane, and we'll be happy to help. So thanks again, Josh.
No worries.
Cheers. This podcast was brought to you by Ramsey & White Finance and Property Investors. We specialise in helping property investors fund their deals all across the UK. We also have Ramsey & White Wealth Management, Accountancy, and Ramsey & White Estate Agents. I want to say a huge thank you to our sponsors, Mariana Capital, who specialise in bridging and helping clients momentum invest by putting the right finance in place for their projects.